the other side, which is what I experienced with renting, is you can be kicked out at any time. And so had been in the rental for years. My children were happy, they were settled, and then the landlord decided to sell. And so now you have to uproot your family at a time that can be stressful and can be very very stressful on your children. And so
welcome to the Business Ownership Podcast, brought to you by Awareness Strategies, helping you navigate the waters between entrepreneurship and ownership. Hey there, peeps. This is Michelle Nedelec, and I'm super glad that you're here with us today because I am here with my most amazing guest, Pam. Pam, thank you so much for being here with us today.
Thanks, Michelle, for having me.
Awesome. So give us a highlight of who you are and what you do for business.
I'm Pam Pettie. I'm a mortgage associate with Enrich Mortgage Group, and I help people get into homes so that they can stop surviving and start to thrive in their lives.
That is awesome. And we are going to delve into that completely because I know that's a little bit of controversial subject now, which it never has been before. We're going to delve into that, and it's going to be a little fun. But how did you get into the mortgage business as a thing?
How did I get into mortgage business? I came from a high school math teacher, and was looking for a change. And since I like numbers, looked at careers involving numbers and like helping people. And so that kind of merged. And I had gone through a divorce, and looking back, I wish that I'd had a mortgage person that I could speak to that would have helped me to navigate that time in my life, helped me to know that I could have stayed in the house, keep the roof over my children's head.
Oh, brutal. So let's go back to that, because I think that is the crux of kind of what's happening for people is one, not understanding money at all, not understanding debt and debt. The differences between different kinds of debt, what you can hold, what the rules and regulations are around it, and all that kind of fun stuff. I know we only have about half an hour, but answer any one of those questions that you want to right off the bat. No, I'm kidding. So let's talk about kind of what happened to you, what was going on for you at that time, and then we'll get into kind of what could have been done.
At the time, I was not working, so I wouldn't have qualified for a mortgage on my own, and I knew that. Even though the mortgage amount would have been small, I was getting the bulk of the family home as part of my settlement. Trying to navigate that, if I had some advice where I could have gotten a co-signer, I could have had a family member that would have co-signed. My mortgage payments at that time would have been less than what I had to pay in rent. And so it was just a matter of knowing maybe I don't qualify on my own, but who could I ask within my immediate family just to co-sign, because I could have afforded the mortgage payments because I was paying a lot more in rent.
Right. So talk to me about, and we'll get back into this because I think it's super important for people to be able to understand, but I have heard rumors that there is a trend moving from home ownership into preferred rentals. And I don't quite understand it because to me, owning a house was always the first asset that you actually really wanted because it was the first real asset that somebody usually acquires before a business or otherwise. So am I wrong in that thinking? Are they right? What's your opinion of that?
My opinion, I think you're always better to own versus rent for a number of reasons. Even if the market is going up and down, because and that was one of the advice that I got. The housing market was going down, and if I chose to sell, I was going to lose money. You're only going to lose money if you sell at that at that particular time. If you hang on to it, you're going to recoup your investment. The other side, which is what I experienced with renting, is you can be kicked out at any time. And so had been in the rental for years. My children were happy, they were settled, and then the landlord decided to sell. And so now you have to uproot your family at a time that can be stressful and can be very very stressful on your children. And so to keep them in a home that they're used to, in a home that nobody's going to kick you out, sometimes is a better choice. And financially, if money gets tight, if you own your own home, you can always refinance that home and pull out some of that equity to tide you over those difficult times, things that may happen during that period of life where you might need a little bit of extra cash. If you have that equity in the home, I kind of think you're in the driver's seat. If you need to sell and downsize into a home, you have that option. If you need a little bit of extra cash, maybe your car breaks down and you need to buy a new car and now you can't finance that, you can pull out equity of from your home and use it for that. Even if a major repair in the house, you can always pull money out of that property because you own it. So if you can stay in a home or purchase a home, I think financially in the long run, you're a lot better off, and you have a lot of options that wouldn't be available if you're renting.
Awesome. So we'll get into kind of the depths of how you can utilize mortgages to your benefit and kind of some of the more high level things. But let's start with kind of the basics of the difference between consumer debt, or what I call consumer debt, and asset debt, meaning a mortgage or something like that. Use your terms, and how do you explain the differences to people?
Consumer debt isn't really an asset. It's a depreciating thing. If you have a car loan, it's a depreciating liability. The car is decreasing in value, and yet you still are paying on that. If you have credit card debt, that's things that you have purchased. There's no value to it. Even if you had to sell it, you're not going to get out of it, and yet you're carrying debt. Certainly if you carry credit card debt at 20%, that small purchase that maybe cost you $100 over time could end up costing you $300 or $400 by the time you've paid interest. An asset debt would be something that could appreciate, like a home. 1 year it might not go up, but over the course of 5 years, your home, that asset, could go up as much as 10-20%. There's been times in Calgary where homes in a year, in crazy times, homes went up 30% in a year. That is a good asset to hold. Good
Right?
value.
Well, and Calgary tends to be a little bit of an economic island unto itself. I find that we tend to have booms and busts every 10 years, regardless of what anybody else goes through. And yeah, we have those crazy markets where things can go up 30%, where we can sell it for more the next day than we did the previous day, which is kind of funny. So let's talk about, because I don't know if especially young people kind of have the same grasp on, if the value of a house depreciates, you haven't really lost money until you sell. So talk to me about kind of that whole concept of the market going up and down, and where is your mortgage while that's happening?
Most people now lock in for a 5-year fixed rate, be that a fixed rate or a variable mortgage. And what that means is your payment on that mortgage isn't going to change for that 5-year period. So you can budget, what your living costs will be. And if the house value does drop maybe 5%, as long as you don't have to sell, that payment stays the same. There's no change to that. And like I said before, because you've got equity, if something unforeseen happened and you needed finances, you're not in a position where you're forced to sell. You could pull equity out to get you over that time, so that you're not having to sell your home in a depressed market. Most of the time the market it fluctuates. Maybe wait 6 months and then you could put the home for sale and you would recoup. Housing over the long haul in Canada is a good investment. It is something that is going to appreciate.
Nice. And when you're looking at that appreciation, kind of what are some of the things that you want to consider? Like, let's say we'll start off with the younger people. They're just starting off, they're 25, 30, whatever, starting a family, going to buy a house. What are some of the things that they want to consider that will have long-term impact?
They're going to want to consider what they can afford. Mm-hmm. And that's where a mortgage agent comes in. We take a look at their incomes. We take a look at their debt load and come up with a formula and say, this is how much of a mortgage you can carry. I don't recommend anybody carry the maximum amount of mortgage. Have some wiggle room. If it's your first time home, for a young couple, think about, are you going to start a family within the next 5 years? If the answer is yes, then you're going to want to look at a house that has a bedroom, an extra room for a little one. If you know that that's not going to happen, you don't want the yard work, then maybe a condo would be more beneficial to you. And also you need to look at areas. There are some areas that sell better or faster than other areas, just with the amenities that are in the area. So for a young couple, it's kind of what is their short term, what is their plan within the next 5 years? If they're not planning on selling, then you can kind of pick a little bit more of what you want. One of the things that I have found with young first-time home buyers, they want it all. They want the stainless steel appliances and the beautiful kitchen and the hardwood floors and the granite countertops. They want all the bells and whistles in your house. And I have seen it where I've had a young couple. I would say that they overbuilt their home for the area. They bought a starter home, put in wood floors, the granite countertops. Not the best use of funds. Now, when they went to sell their house sold very fast because it was a beautiful starter home, had everything. From a financial point of view, they did not recoup what they had put into that home. Now, if they had bought a home in the mid-range with families and they had put those renovations in, then they would have recouped a good chunk of those renovations. So sometimes it's helping young first-time buyers, what do you want? And don't make your home you don't want to be the highest home on the street or the highest home in the neighborhood, because then when you go to sell, you'll sell fast, quickly. And if other neighbors have their homes for sale, you will actually sell their homes faster because they will be at a lower price point. And people will look at your home and say, that's out of my price range, but the other homes in the area are. So, long term, what's their 5-year goal?
So when you say it sells quickly, I'm thinking that's a good thing. They probably underpriced it, but then again, they couldn't potentially have offered kind of over what that neighborhood
would
demand. So if
So it
you're in a
sells
neighborhood
quickly.
where it's like 400,000 is the top price, you're not going to get more than that in that neighborhood. Then you're like, well, yeah, I can sell for 400, but we put 450 into it, which kind of
Correct.
sucks.
Yes. And
Okay.
that's exactly what can happen. Yes, you bought the house, you put $100,000 worth of renovations. You won't get that out.
Mhm.
Now, if you plan on staying in the house for 10 years,
Mhm.
you may get that, be able to recoup that. But you don't want to be the nicest house in the neighborhood, because chances are you will not recoup what you've put in.
Absolutely. So my advice for somebody, if you're looking to do that and reno your house and then flip it, go and get a lot of advice first. So
Yes.
ask a lot of questions from people that do that for a living, because they know the ups and downs, the ins and outs, and odds are they're very willing to give you some free information, at least to get you started on the whole path, and then a whole lot more information that'll be helpful then. But let's go back to kind of the mortgage idea and looking at increasing net worth. In your experience, is it better for people to buy and hold through markets, or is it better to kind of buy? I wanted to say buy and flip, but do short-term kind of gains throughout their lifespan, depending on the size of the family and the size of their house, their school demands, all that kind of fun thing. Does it work out better financially to move every, say, 5-10 years, or is it better to stay and hold for 40 years if they can?
$1 million question.
Right?
Yeah.
And if you knew that and you have a crystal ball, you just go ahead and share that with us. It'd be awesome.
Yeah, and then again, depends on your needs, right? Like to hold a home for 40 years, 50 years ago, that's what people did. They bought a home, you lived in it, and you never moved. You could still do that today, I think, financially, to every 5 to 10 years, which is when your mortgage is going to be coming up for renewal. That's the time to look, have my needs changed? Do I need a bigger home? When you do that, you can take the equity that you've built up in that first home and use it to buy a larger home, and your mortgage payments stay relatively the same. So you are increasing your net worth without increasing mortgage payments as you do that. The other advantage to doing that, if you stay in a home for 40 years, you're going to have renovations that you're going to have to pay for. Bathrooms do not last 40 years.
Unless you really like avocado bathroom.
Or pink. Pink.
Yeah, exactly.
Kitchens. So
right.
Over, an older home gets tired, it's going to need reservations. Your bathrooms, kitchens, flooring, all of those things. And all of those things are expenditures that you'll be putting out. So I think it comes to personal taste. If you love the house and love the neighborhood, are you prepared to do those renovations knowing that you won't be recouping those? If you don't need more space and you love the neighborhood, then you could do the renovations. That area most likely is going to increase in value if you hold over the long haul. For a family that needs more space, and maybe they move from a starter home and now they can get into a home with the hardwood floors, they can get into a home with the granite without their monthly payments being much different than what they were before, because they've used that equity has built up. And there is if you look at starter homes for young people, there is a limit to how much that home is going to increase in value. You're not going to buy, say $400,000 for a starter home in Calgary.
Calgary, yeah. That doesn't necessarily apply all over the world. I know, and we're looking at starter homes for $40,000 in some American cities.
Yes,
they're looking at us going, $400,000 for a starter home? Are you kidding me?
Even if you look at a $40,000 starter home, in 10 years, that $40,000 starter home is not going to ever be worth 100 or 150,000. It might be worth 50,000. It might move to 60,000. but you're
but
not.
it's likely to maintain with inflation and the standard cost of
Yes.
living and all that kind of fun stuff. And you got to take that into account too. Talk to me about the interest rates and what's going on. So what do you, well, let's start back up the bus. What do you think is going to start happening in January? Just as we're at January 2023 coming up. What do you, if you had a magic crystal ball, what do you think might happen?
With interest rates, I don't think they've finished going up. So there's going to be a lot of people whose mortgages are coming up for renewal, that are going to be in having some difficult conversations. When when interest rates were 1.5%, you could afford a lot of house, and now you can't afford the great big home.
Well, and I think too that when the mortgage rates go from 1% to 2%, we don't calculate that that's actually 100% growth of the interest. Like that's a pretty substantial jump in the whole calculation of things.
Yeah, and I've got some clients that are in a variable rate, and when they started, $1,200 a month, and now they're up to $1,800, probably going to go up to $2,000. Well, if you were budgeting on $1,200 and now you're at 2,000, that's a lot of extra money going into a mortgage. There'd be some variable rates that will hit a trigger point where the payment does not cover the interest, and they have some tough decisions to make, because they're going to either have to increase their payment, put a lump sum down, or increase their amortization when they go to renew, if that even is an option. So there's going to be a lot of tough decisions coming up.
Absolutely. And I think, again, it comes back to the importance of having discussions with your mortgage broker and being in constant conversation, like what's going on, how does this affect me, what do you see happening in the industry, because every city is different, every state's going to be different, every country is going to be different because of the rules, regulations, all that kind of fun jazz as to what happens and how we can start to play with all of these things. Because at some economic points, it makes sense to have a variable mortgage. In fact, it's hugely advantageous. And then at other times, it can be hugely disadvantageous, and vice versa with fixed mortgages, all of which can come crashing down. And, having gone through the 80s in Calgary in particular, when mortgage rates were like 12% and they went up to 15%, like that was insane. And people had to walk away from their mortgages at that time because it just wasn't feasible anymore.
Yeah, like people are going to make have tough choices. The ultimate goal is to keep that person in their home, whatever means that is. I'm going to assume there's going to be times when that won't happen, just because they took out the maximum mortgage amount, so there is no wiggle room in their budget. Somebody that's bought a house 5 years ago at the 2%, and now coming up for renewal, and renewals are 5.5%. That's a huge increase in their monthly payment. Has their income gone up that much to account for the increase that the home is going to be? And then it comes down, even if they have to sell their house, how long is it going to take to sell a house? A house in the $1 million range is going to take a lot longer to sell than a house in the $100,000 to $200,000 range. So if you're in $1 million house or 800,000 and you can't afford that mortgage, how are you going to hang on until that house sells? Are you going to have to reduce the price because you can't afford to stay there? Like, there's going to be some tough decisions coming up.
Well, and personally, I think I see that people that have houses smaller than $1 million tend to have more kind of issues with it, in that options don't tend to be as obvious to them that somebody that has created $1 million worth and has that house tends to see options as a viable thing. They tend to be talking to their bankers and their brokers, and they tend to be more into conversations about money. Like, I don't want to say that it's better or worse. It's just, that's the mindset is, okay, this is all about the money, and how do we negotiate this? How do we figure it out? Do we rent out the garage's space? Like, what do we got to do to make this happen? And they start brainstorming over it. Whereas people that are in their first home, you know, they're just going by what they know, and they don't necessarily have the experience to go, hey, I could bring in a renter. Hey, I could rent out my garage. Hey, I can, you know, that there are other options available to them depending on where their house is, and rules and regulations, all that kind of fun jazz. And I think those are going to be very important conversations to have if somebody's facing that. To, number one thing to do is not panic. It is to breathe, relax, contact somebody that has the experience in that area, and to look at options, because there are a ton of options. And it may be to rent out the house to somebody that's business is doing well, because in all economic terms, somebody is doing well, and they may want to rent your house out as opposed to buying somewhere else because they need to be in that city for a year or two and they don't really want to buy. They just want to rent. Like, you can almost wave a magic wand and go, okay, if I could have anything happen the way I wanted to, what might it be? And then from there, go start asking questions of, okay, how do we potentially make that happen? But it'll never happen if you don't start asking the questions.
No, you need to ask the questions and you know, speak to somebody in the industry that's knowledgeable. You know, talk to a realtor, find a mortgage broker, have those difficult conversations. You know, have a mortgage broker work out the numbers. You know, I can run multiple scenarios for clients. You know, if this happens, what are your options? If we, you know, pay the penalty for the mortgage that you're in to move you to something else, which is a better product, what is the cost? What is the savings? What is the long-term outlet? Like, those are all numbers that I can work with to give you options. Think outside of the box. You know, maybe it's, you need an extra $200 a month. Well, how can you find that? You know, if you live in a university town, do you have a bedroom you could rent out to a student? You know, is that an option for you? Is there some way that you can come up with that extra money? And you know, I've worked with clients where it is in their best interest to switch from the institution that has their mortgage to a different institution, because they have a product that at this particular time meets their needs better than the one that they're in. And that's even calculating, you know, if they have to pay a penalty to move to a different lender. Now, sometimes it isn't beneficial, and sometimes it is. And that's where, you know, it's a numbers game, and we can work the numbers to give you, you know, all the options that are available. The choice in the end is ultimately yours, what you want to do, but at least we can give you the knowledge to make an informed decision.
Absolutely. So let's talk about the argument of to pay off or not to pay off, because to me, that's always the question. So, do you really want to pay off your mortgage, or do you want to maximize that? And obviously there's going to be different people with different, what are the arguments for and against, and when does it matter?
Me personally, I don't think somebody should. I mean, most people's goals is to pay off their mortgage. The cost of
especially
the cost of a mortgage is cheap money. You can invest that money at a much higher return than what it's costing you. Now, I'm not saying you shouldn't pay off your mortgage, but I think as you build equity in your home, the goal to have a mortgage-free home isn't necessarily the best thing. I think as people get older and you pay off the mortgage, not so much have a mortgage, but set up a HELOC, which is a home equity line of credit. So if you've paid off your mortgage, then set up a home equity line of credit. It doesn't cost you anything unless you use it. If you have repairs on the home, you have access to cash at a much lower interest rate than if you were to take out a line of credit at the bank. As you get older, I believe as people get closer to retirement and as long as they're still working, that is the time, if the mortgage is paid off, they should be setting up a HELOC. Then you can pull from that if an expense comes up or you want to go on a trip, rather than pulling out of your retirement savings to use that HELOC money. That's tax-free money to use it. If you're pulling out of a retirement savings, you're paying 30-40% tax on that money, so you're losing a good chunk of it. Whereas using the equity in your home as that buffer is an excellent way to have access to funds tax-free.
And of course, we're talking about all of the rules that exist exactly right now at this point in time. So you really want to go and talk to Pam and get some current advice, because God knows when you're listening to this. So awesome. Are there any questions I should be asking, or that people should be asking a mortgage broker that they might not be?
That's a good question.
Well, and oftentimes I'll let you think
about it. I think when you're talking to a mortgage broker, and I find this, be honest with them. I've talked to clients, they have an excellent Beacon score, they have good credit. And then you start talking to them and find out they have lines of credit, they're carrying high credit card balances, and all of those things impact the amount that you can get for a mortgage. So my number one advice is make sure you're honest. Tell them what your debts are. If you've had a period where you've gone through bankruptcy or consumer proposal, let your mortgage agent know, because then they can direct you with options. Somebody that's been bankrupt has different options than somebody that has credit. A mortgage agent can help you to, and I think for right now, consolidate your debt. What would you rather do? Pay 20% on your credit card, or roll it into your mortgage and pay, well, right now, say 5%. So talking to a mortgage agent, they can really help you with your cash flow. And you have to look at it not necessarily the rate, because sometimes the lowest rate isn't really the best product for you. You can refinance and maybe you're paying a higher interest rate than what you are in your home, but you've got an extra $1,000 of cash going into your bank account because it's not servicing high interest debt. And somebody closer to retirement, we can set you up with a HELOC. There's some lenders out there that work with a kind of as a bank account. So when your paycheck, and this is good for mid-age people, as your paycheck goes in, that's coming right off the principal of your mortgage. And by working that, you can still pull the money out to pay your bills. But having your mortgage set up that way, it can save you 10 years on your mortgage payment, which is a phenomenal amount of interest that you can save. So, hey, speak to a mortgage agent. We know numbers. Be honest with your financial situation. We find out anyway, but it's much better.
We don't want to find out the hard way.
We don't want to find out the hard way, because we can't help you if you're not honest. And kind of letting us know what your goals are. Like, some people, they want to buy a rental income. So how can we, maybe right now that's not feasible, but we can work with you and set you up in a situation so that maybe a year down the road or 2 years down the road, now that goal becomes a reality. And like we can help people with short-term goals, and sometimes their goals may take a little while to get to.
And I think that's a great point, is that a lot of people think short term. Okay, I'm ready to do this now. Now I'm going to go do it. As opposed to you guys are dealing with people for 5 years, 10 years, 25 years. Like, it's like, that's, today, tomorrow, it's a blip in my life. So if you come early and have those conversations, then if there's something that is a roadblock, that you have the time to be able to clear it up and to change credit ratings, to change debt loads, to move things around and get creative with financing. And I think the most important thing is we don't know what we don't know. Whereas experts like you do know, and you have the experience. It's like, hey, have you thought of this? And you're like, what? You can do that? Like,
And
because
even
we don't
if we
realize there's different products, there's different services, there's different rules and regulations, there's, economies change. All of these things have factors. Sometimes it's more beneficial to be an employee. Sometimes it's better if you're an entrepreneur. The rules, regulations, what the bank's looking for, all of those things can change, ebb and tide. And it's so important to just get current information and work with you.
Yeah. And even if we don't know because we don't know everything, but we have a team of people that we work with. So, I've had clients where, in a situation, I'm like, I'm not entirely sure what would be the best for you, but I have a whole team behind me, so I can put your scenario. We have daily meetings. I can put your scenario up and go, has anybody else came across a similar situation? What's the best solution for that particular client in that situation? So they're actually getting the knowledge from a lot of people.
Nice. I love it. So I know that our listeners are going to want more from you. So how did they start their journey with you?
You can contact me through mortgage, Enrich Mortgage, Mortgage Alliance, Pam Pettie, Pettie at enrichmortgage.ca. It's probably the easiest way. Shoot me an email, and be happy to
start talking. Nice.
To help
and
you.
We will, of course, have that email in the links for you. And if you don't find that, come back to awarenessstrategies.com/blog. Look for Pam or Petties or Enrich or mortgages. I'm sure you will find her. It's all awesome. Excellent. So, Pam, I get to ask you at this point, at what point in life did you know that you're a special kind of crazy enough to think that you could become an entrepreneur?
That's a good question. Probably has nothing to do with anything.
And yet everything.
And everything. I'm a triathlete. I have represented Canada on the world stage with
Nice.
triathlon, and probably training and completing Ironman races. I'm going to get a dig in for that.
Nice. Yeah.
Teaches you a lot about yourself, and teaches you that you can do hard things. Being an entrepreneur is not easy. You work 24/7. When clients call, you try to help them, and so probably just doing that allowed me to be, I guess, brave enough to leave the safe world of high school math to go into another area of math, and just the desire to help people. Triathletes, we're a pretty friendly bunch, and when we're out there a long time, and we help each other, and just the camaraderie with that. So knowing that I like to help people, I like numbers, and that I had the strength and the courage to branch out.
Nice. I love it. Well, I'm glad you did. And yes, I love the special kind of crazy that triathletes are as well.
We're a breed of ourselves.
Exactly. And it's always fun to me. It's kind of like the entrepreneurial world when somebody comes in like, hey, so do you run your own business? And they're like, no. Same thing happens at the triathletes. Hey, do you run triathletes? Like, no. Hey, do you
No.
want it? Come on in. Super fun. Like, yeah, I'll wait until after the race and then I'll decide. No. But yes, it is super fun to see you guys all in action and all of the kind of mindset that goes along with that. And I know you're a huge advocate for helping people. So if you're interested in triathletes, peeps, go ahead and connect with Pam. I'm sure she'll be happy to set you up on that one too. Got some epic stories there that we'll cover maybe another time. Awesome. So thank you so much for your time, Pam. You've been awesome. Any last words for our peeps?
Say don't be afraid to ask questions. Purchasing a home is probably the biggest purchase that people make, and I would say that they probably spend more time trying to pick out a pair of socks and buy a pair of socks than they would buying a house. And information is knowledge. Go to people, a realtor, speak to a mortgage agent, and find out what your options are. Find out as much as you can, so that you can make an informed decision. You don't have buyer's remorse, and that financially that you've made the best possible decision for you at that particular time.
I love that. And I think people that treat buying their house like it's a business end up with a much more solid plan of attack and a strategy around it, because you see all the opportunities that can be and where do you want to be with it. It's not just, oh, I like this house, I'm going to buy it, and oops. There's a whole lot of options and abilities beyond just four walls and a door.
Yeah.
Nice. Awesome. Pam, thank you again so much for your time. I appreciate it. I know how valuable it is. Thank you for being here.
Thanks for having me, Michelle.
Awesome. Peeps, thank you for being here with us today. Be sure to subscribe to the show and share it with your entrepreneurial friends. We love helping you grow.
Are you running a business over 7 figures but still struggling with technology headaches? Pay attention. You do not want to miss this offer. This podcast episode is brought to you by Awareness Strategies, who is offering a custom-built digital adoption roadmap for anyone running a business over 7 figures who's wanting to grow their business in the next 5 years. And it's not just a roadmap. They offer full implementation as well, if that scares the out of you. Check out awarenessstrategies.com/roadmap for more details today. The link's in the show's notes. Don't regret not doing this. Do it now. That's awarenessstrategies.com/roadmap.